This is Satya Pradyuman of Cirrus Research. The latest issue of the briefing report is just out. The title, Speculation Has Room to Run Despite Crowding Concerns. This is a look at our Cirrus risk score. This represents the risk appetite and the risk-taking really of the US equity markets. What this reading is suggesting is that really since last year, we've seen risk appetites bottom and really recovered. At the heart of this measure, though, it is a contrarian measure, which suggests that as risk-taking increases, there is a sort of boundary that it hits that becomes too extreme. Based on this current reading that we've got, we're shy of this overly speculative backdrop. So with the promises of interest rate cuts and the fact that you've got a weak dollar that'll support the earnings backdrop, in the short term at least, this suggests that risk-taking will likely accelerate. At least based on this model, there is room to run. Importantly, we also have a strong support on the AI investment theme. More than ever, it does look as if a massive amount of spending will now begin to occur at the corporate level. So what's going on here is that we're now moving to this downstream play on AI. As a result, what we're seeing is a broadening of the AI theme. Our upstream measure, basically the chips, year to date, they are lagging versus the AI downstream groups such as big data, data centers, cybersecurity. All these are the components that are going to come into play the more we roll out AI applications. So this broadening is constructive, and it is likely to underscore this sort of speculative run. Looking globally, what we find is that the US equity markets are lagging sharply versus other key regions. This is a real turnaround from the prior year. What the scatter plot relates is the performance last year. What you'll notice is the US was up in the higher 20% range, probably one of the best performing markets globally. When you look at this year, that's the y-axis, most of these other markets are outperforming the US, and the US is a laggard. So the question is, what's driving this? Part of it is the tariff overhang, but in addition to that are real concerns on the inflationary outlook in the US. If you take this a little step further, what you'll notice is the term structure has backed up in the last 6-9 months. So this is really underscoring the concerns that investors have for the inflationary bounds that we are seeing in the US. With any questions, feel free to reach out.